So we are studying capital structure theories, and I said equity is expensive, debt is cheaper, and therefore net income approach says that. Therefore, net income approach says that if you increase the proportion of debt in capital structure, in that case, your overall cost of capital actually reduces. If you increase the proportion of debt in overall capital structure, then your overall cost of capital actually reduces. That is the net income approach. Now, you know, the net operating income approach is just opposite. Net operating income approach says that even if you increase proportion of debt in capital structure, overall cost of capital will remain same. Why is it so? When debt is cheaper, equity is expensive, KD and KE remains constant. So when I increase proportion of cheaper source, my overall cost should come down. Why? Net operating income approach is saying that it will remain same. You know, the reason is quite simple. Net operating income approach says that your cost of debt, what are the assumptions of net operating income approach? It says that your cost of debt remains constant with increase in debt equity ratio. If debt equity ratio increases, your cost of debt actually remains same. But the cost of equity doesn't remain same. It increases with increase in debt equity ratio. So when I borrow more money, my financial risk increases. When financial risk increases, then equity shareholders, if financial risk increases, then equity shareholders will see that their investment has gone riskier. They have to take more risk, and that is why they will expect more return. And therefore, with increase in level of debt, cost of equity rises. Debt rises, risk rises, expectation of equity shareholders, that is KE, also rises. So on one hand, by borrowing more amount, you're getting cheaper debt. But on the other hand, equity is getting equally expensive. So whatever advantage of cheaper debt you are getting is compensated by expensive equity. And that way, overall cost of capital, KO or WACC, whatever you name it, will remain constant. See, look at this diagram. KD remains constant. KE rises in proportion to debt, and therefore overall cost of capital remains same. So if you are getting greedy, that cheaper debt will reduce my cost, be cautious. Cheaper debt will cause equity to become expensive, and ultimately you will remain at the same level. You know, so what will be the new cost of equity? If you are interested in knowing that, then this is the formula. Cost of equity under net operating income approach is equal to overall cost of capital. Yes. Plus KO minus KD, overall cost of capital minus cost of debt, multiplied by debt upon equity. Okay. What do you see in this formula? If debt equity ratio rises, then cost of equity also rises. Sir, how do you derive this formula? See, it's very simple. I started with this formula, which is nothing but the formula for weighted average cost of capital. Cost of debt into amount of debt plus cost of equity into amount of equity, whole divided by debt plus equity. So KO, it is the formula for weighted average cost of capital. If I rewrite this formula for KE, that is, I shuffle the formula. In that case, it becomes a formula like this. So kind of, NOI approach, they have just reversed the process under the NI approach. They have assumed that overall cost of capital will remain constant, and therefore now you can derive the new cost of equity. The steps for calculation are also just opposite. See, in the last session, I have shown you this calculation of NI approach. Under NI approach, you start with EBIT, deduct interest, so that is profit before tax. But NI approach assumes that there is no tax, so that is also profit after tax. There are also no preference shares, so that is also earning available to equity shareholders. So under NI approach, this is NI, okay? This is NI approach. You start with EBIT, you deduct interest, you get earning available to equity shareholders. Then you divide it by cost of equity. Try to recall. EPS divided by KE gives you market value of the share. So here you get market value of entire equity. Then you add market value of debt to arrive at market value of firm. And observe over here that in the second column, wealth is higher. In the first column, wealth is 2,60,000. In the second column, it is 2,70,000. Why? Because in the second column, there is more debt. So higher the level of debt, higher the value your firm will command in the market. Then if you want to calculate overall cost of capital, so I told you the shortcut formula, and that is EBIT divided by value. So when you do EBIT divided by value, in first case, your capital is expensive, 11.54, while in second case, it is cheaper, it's 11.11%. Why it is cheaper? Because the proportion of debt in this case is higher. You see, it's 1,50,000. So this was NI approach. Now, how do I solve a question under NOI approach? Here the process will be, just reversed. See, the same example. Capital employed is rupees 2 lakh. Overall cost of capital is 12.5%, and that's going to be constant. ROI is 15%, and therefore EBIT is 30,000. On 2 lakh, you're earning 15%, that's 30,000. Calculate market value of firm. Oh, no. I will say calculate cost of equity for the following two options. Option 1, you have debt of 1 lakh. Option 2, it has higher leverage. Its debt is 1,50,000. So now observe carefully. You start with EBIT, just like NI approach. But now the whole process is reversed. Under NI approach, the last calculation is KO. But under NOI approach, the first thing you are going to adjust over here is KO. So overall cost of capital, 12.5%. I divided by this. Try to recall the shortcut formula which we studied while studying NI approach. And the shortcut formula was like this, that overall cost of capital is equal to EBIT divided by value of the firm. So if I rewrite this equation, it will become value is equal to EBIT divided by overall cost of capital. So now I'm doing it like that only. EBIT should be divided by overall cost of capital to arrive at the market value of firm. See, EBIT is same because EBIT is not dependent on capital structure. Overall cost of capital is assumed to be same. Yes. Market value of firm is bound to be same now because EBIT is same, overall cost is same. So market value of firm is also same under both options. Now I deduct value of debt to arrive at value of equity. Just opposite to NI approach. There you start with value of equity and then you add value of debt to arrive at value of firm, and then you use value of firm to calculate overall cost of capital. Here you are using overall cost of capital to arrive at market value of firm. Then you deduct value of debt to arrive at market value of equity. Once you arrive at market value of equity, you can easily calculate cost of equity. Now, how do I calculate cost of equity? That's a question. You already know that how to calculate cost of equity. It is EPS divided by P. You know, what is the formula for calculation of cost of equity? It is EPS by P. But rather than taking per share, you can take it in total also. So like here, EPS means earning available to equity shareholders. And earning available to equity shareholders is, you know, you'll have to calculate it. Yes, Vinaya, I will answer your question. But first, let me calculate earning available to equity shareholder. EBIT is 30,000. Interest will be 10,000. So earning available to equity shareholder is 20,000. Should be divided by market value of equity. Can you just check it? 20,000 divided by 1,40,000. Is it 14.26%, 29%? And here it is 15,000, 30,000 EBIT divided by, 30,000 EBIT minus 15,000 interest will give you 15,000 earning available to equity shareholders divided by 90,000. That is 16.67%. So you can see here that the option 2, which has more amount of debt, in that case, the cost of equity is higher. You know, this calculation method is reversed. So it's kind of weird, but the logic is solid behind it. When you borrow debt, when you borrow money, your risk increases and therefore cost of equity also increases. And therefore overall cost of capital is expected to remain same. How 20,000? Okay, this 20,000 is earning available to equity shareholders. So I was just trying to avoid some of the steps, but now I'll tell you. Give me one moment. I'll make some space to write. Look, EBIT is 30,000. Interest is 10,000 and 15,000. So earning available to equity shareholder will be this. Okay. Now somebody was asking, how do I decide which method to apply? In this case, they simply ask to find out the cost of equity. Oh yes, you know, they will ask you which method to apply because different methods have different assumptions. See, what NI approach was assuming cost of equity will remain constant. What NOI approach is assuming cost of equity will increase with increase in amount of debt, right? So that way, different assumptions are there, and therefore they will actually specify that which method to use. So you don't have to assume the method. Question itself will ask you this. So Titiksha is asking, where can I get these notes? Probably you missed last 2 sessions. I told you, you can visit my website, fmbytm.com. There you will get everything Read all instructions carefully, and all notes are freely publicly available over there. I have posted it for students like you, everybody. Okay. Now the next thing. So the thing here is NI and NOI is done. But let me tell you one thing. If it is without income tax, NI approach assumes there is no income tax. But when we introduce income tax in NI approach, its conclusion remains same. So I will kind of write all conclusions at one place. Net income approach, and this net income approach is without tax. That's the basic assumption of NI approach, that there is no income tax. WACC, when I say WACC, I mean weighted average cost of capital. And WACC and overall cost of capital. No, not overall cost of capital. WACC and overall cost of capital are one and same thing. Wealth means total market value or firm value. So WACC and firm value changes. When does it change? I'll tell you. When capital structure is changed, when capital structure is changed, WACC and the firm value also changes. That is net income approach. With increase in level of debt, WACC reduces and wealth increases. But if I introduce tax, then it will become net income approach with tax. You know, even after introducing tax, even after introducing income tax, what happens? Weighted average cost of capital reduces rapidly and firm value increases rapidly. What does it mean? After introducing tax, net income approach works even better. Now, if I talk about the net operating income approach, net operating income approach without tax, then it says WACC and firm value remains same. And if I introduce income tax over here, then the conclusion will change. Now observe this. This says it will change. This also says it will change. This says it will remain same, the overall cost of capital and firm value. And this says it will change. So what you can observe over here is that if you introduce income tax in net operating income approach, then its conclusions are in the same direction as the conclusions of net income approach are there. Vinay is saying unable to download notes. Vinay, Please concentrate here. I said I have given you a web address, and with a cool mind, if you visit that, you will find link to one mobile application. You will have to install that, and with a cool mind, read all instruction carefully. Otherwise, you will be stuck somewhere again. And there are several steps to be followed, and there you will find notes. Notes are not really important. Understanding the concept is really more important. So focus here now. Now, net operating income approach. Net operating income approach with income tax. What does it say? It says value of my God, you guys are interested only in notes. This is the web address that Diksha I recently shared. Here you will find instruction, not notes. Okay, so I was telling you VL, that is value of levered firm. So I'm talking about NOI net operating income approach with income tax. So value of levered firm is equal to value of unlevered firm plus debt multiplied by tax rate. You know what NOI was saying? NOI was saying that the value of the two firms will remain same. Look here. Under NOI approach, market value of both firms remains same. But if you introduce income tax, what does it say? It says that value of levered firm is equal to value of unlevered firm plus debt into tax rate. So let's solve one question quickly on that. And how do you calculate value of unlevered firm at all? So value of unlevered firm is equal to EBIT divided by weighted average cost of capital. So first you calculate value of unlevered firm, then you add to it debt multiplied by tax rate to arrive at the value of levered firm. Okay, we don't have time for a numerical probability. So now let's talk about the one of the toughest approach, which is named as Modigliani and Miller approach. If you focus, you are going to enjoy this approach. Otherwise, this approach becomes a kind of headache, that how to, or especially people don't get logic behind it. So now I'm going to tell you what is the logic behind Modigliani and Miller approach. See, the Modigliani and Miller approach also has the same conclusion like NOI approach. NOI approach says that even if you borrow money, your overall cost of capital will remain same and market value of firm will also remain same. M&M is also saying the same thing. Even if you change the capital structure, even if you start to borrow money, overall cost of capital will remain same and market value of the firm will also remain same. So have they copied the concept of NOI approach? No. They have a different way to prove it. And Modigliani and Miller actually used the arbitrage process to prove their approach. Do you know what is arbitrage process? Ghazal is asking, can you solve a question on NI and NOI? Ghazal, I have already shown you a numerical on NI and NOI. Yes, I have solved it. This is how you solve the NOI question. You start with EBIT divided by overall cost of capital. You arrive at market value of firm, then deduct market value of debt to arrive at market value of equity, and then you calculate cost of equity, full stop. We solved it, don't worry. And now we will solve it for Modigliani and Miller approach also. You know, time is limited and the syllabus is huge. So we cannot have more than one numerical, and sometimes we'll just have to go through concepts. So look here, I was telling you, Modigliani and Miller conclusion is same as the conclusion of NOI, but the way they are proving is entirely different. Modigliani and Miller have used arbitrage process. Now, what is arbitrage process? Arbitrage means buying an asset in one market at a lower price and selling it in another market at higher price to make profit. Following are the characteristics of arbitrage process. What is arbitrage? Buy cheaper and sell expensive. Say, for example, you know, arbitrage process can be used anywhere. It's not related to Modigliani and Miller approach. Whenever there is a disequilibrium in price, then the Modigliani and Miller comes into the role. Say, for example, gold price in Indore is 50,000 rupees per 10 grams. And gold price in some other city, say Jalgaon, is 52,000 rupees per 10 gram. Now, this is a mismatch and one can make money out of it. You buy gold in Indore, you sell it in Jalgaon. You buy 1 kilogram of gold. So that will become kind of 50 lakh rupees. And then you sell 1 kilogram of gold in Jalgaon and you will receive kind of 52 lakh rupees. Right? So 50 lakh rupees you borrow, you buy at 50 lakh rupees, you sell at 52 lakh rupees, and the difference amount 2 lakh rupees actually becomes your profit. You immediately buy it, immediately sell it, and you make a profit. Buying from one market where the price is low and selling in another market where the price is high. This is called the arbitrage process. Now there are three characteristics of arbitrage process. There is no investment. You know, you're buying it today, you're selling it today. So kind of it's not, you know, if you simply buy gold and sit on it. I buy gold and after 10 years I'll sell it. Now here you need to make investment. But I'm buying today, selling today, so I don't need to make any investment. No risk is involved. You know, I'm having two phones. On one phone I'm saying, hello, I'm buying. They say, okay, done. Hello, I'm selling. Okay, done. Okay. Now I have entered into a contract, and even within 1-2 hours, if the price changes, I'll not be affected by the price change because I have logged both contracts. So there is no risk. If you buy gold today and hold it for 1 year, then there is a risk that after 1 year, the price of the gold can even fall. It can either rise or it can fall. Then there is positive return. So you need not to make any investment. You don't bear any risk and still you make a positive return. Have you ever looked at it carefully? It is such a wonderful thing. No investment, no risk and still positive return. You invest money in share market, you do investment, you bear risk and still there is no guarantee of return. You can even have a loss. You make a fixed deposit in State Bank of India. Okay, there is no risk, but still you need to make investment. Then only you get the positive return. But I'm talking no investment. You put zero money, no risk and still positive return. If anybody ever get this chance, they will definitely do this arbitrage exercise and will try to make huge money. So whenever you get a chance to do arbitrage, nobody need to give you a motivation. You will do it yourself. And that's why I will say that arbitrage is the self-motivated process. But how do you use it in case of Modigliani and Miller approach? So if you tell me, so can you solve an example? So I'm going to solve one example on Modigliani and Miller approach. To save on time, it is already typed. Look, capital employed is 2 lakh rupees. EBIT is 30,000 rupees. Cost of equity is 12.5%. In additional information, one investor is holding 15% shares in levered firm. Okay. What is levered firm? If you borrow money, you become levered firm. If you don't borrow money, you remain unlevered firm. See, levered firm has debt of rupees 1 lakh at the rate of 10%. And unlevered firm is purely financed by equity. So this is kind of, here I go. Step number 1, under Modigliani and Miller approach, if I give it a name, I'll say it calculation of value. The step number 1 of Modigliani and Miller approach exactly looks like net income approach. You start with EBIT, then you deduct interest to arrive at earning available to equity shareholder. Is it 20 and 30,000? Yes. Okay. Then you divide it by cost of equity. EPS divided by cost of equity give you market price. So earning available divided by cost of equity will give you total market value. Can you just check and confirm that is this figure of 1,60,000 and 2,40,000 correct? Okay, fine. Now, this is value of equity. I add value of debt. Add value of debt. I get total value, and total value is 2,60,000 and 2,40,000. So this looks like an NI approach, which says that if you borrow money, your wealth will be higher. Yes. Step 1 looks like the NI approach. So let's, just for the sake of understanding, NI approach is saying that if you borrow money, you will have higher wealth, you will have higher market value. To which Modigliani and Miller is saying, okay, are you done with what you are saying? And I says, yes, we are done with what we are saying. Modigliani and Miller says, look, now we will prove that you have created this disequilibrium. A firm with higher debt has higher value. A firm with lower debt has lower value. So this is a kind of disequilibrium. And now the arbitrage process will begin. And once it begins, it will be converted into equilibrium. How? That I will definitely tell you. Value of levered firm is more than value of unlevered firm. Therefore, investor will sell his share in levered company. What do you do in arbitrage? Sell expensive and buy cheaper. So investor will sell his share in levered company, and with that money, he will buy shares in unlevered company. This company is expensive, so he'll sell shares in this company and he'll buy shares in this company. And his holding was 15% shares in levered firm. So out of this 1,60,000 rupees of equity, he is holding 15% value. He'll sell it out and he'll buy shares of unlevered firm. So this is kind of step 2. Let's name it as investment. So this nomenclature is not standard. I'm giving it this name. Sell shares in levered company. Market value of equity of levered company is 1,60,000. You multiply it by 15%. So by selling your shares, you will be getting 24,000 rupees. What to do with this money? You buy shares in unlevered firm. Sold shares of levered firm, you got the money. Use that money to buy shares in unlevered firm. I'm sorry. But when you shift from a levered firm to an unlevered firm, there is a problem. When you shift from levered to unlevered, you will feel uncomfortable. You have the habit to take risk. And in this new firm, there is no risk. People have their own willingness to take risk. If you have a habit to drive your two-wheeler at a speed of 60 kilometer per hour, and suppose your parents put a speed regulator in your vehicle so that you cannot drive it at a speed more than 15 kilometers per hour, how will you feel like? You're moving from your home to your tuition, from your tuition to your office, from your office back to home, 15 kilometers per hour speed consistently. Will you feel good about it? No, not definitely. You have a driving habit and you would like to drive at the same speed earlier you were driving, but that is risky. But I have a habit to take risk. I have a habit to make investment in equity shares. And now somebody is suddenly telling me, forget all these things and put your money in FD. I won't do that. So each individual has a risk-taking capacity and willingness to take risk. When I shift from levered firm to unlevered firm, I would like to have the same amount of risk. So I will tell the management of unlevered firm, look, I have arrived in your firm. Now you need to borrow money because I have arrived. And they won't listen to you. Definitely, company will not change its policy because of the need of the investor. But I want to maintain my risk. How do I maintain my risk? Listen carefully. When I was owner of levered company was having a loan of 1 lakh rupees. I was having ownership of 15% in that company. So company was having a debt burden on its head of 1 lakh rupees. I'm 15% owner in the company. So I have debt burden of 15,000 rupees. Are you getting me? Company was having debt burden of 1 lakh rupees. I'm 15% owner in the company. So I have a debt burden of 15,000 rupees. When I switch over to unlevered firm, I would like to maintain that risk. I would like to maintain that burden. And therefore, 1 lakh levered company is borrowing into 15%, my percentage of ownership. I will also borrow 15,000 rupees. So by selling shares, I'm getting 24,000 rupees. By borrowing money, I'm getting 15,000 rupees. 15% shares I sold, 15% amount I borrowed. Now my total investable amount is 39,000. And that's why in the unlevered company, I will be buying shares worth rupees 39,000. My additional investment is zero. Mind it. Even a single penny is not spent from my pocket. I sold share, I got money. I borrowed money, I got money. I invested that money. My bank balance remained same after step number 2. No additional investment. No additional risk is also there. Earlier also my debt burden indirectly was 15,000. Now my debt burden directly is also 15,000. Now, step number 3. Here I would like to calculate return, income, I mean to say. Look, income from shares in unlevered company. Cost of equity is 12.5%. Cost of equity is a cost for the company, while it is income for the investor. So I have invested 39,000 rupees in unlevered firm and I'll earn 12.5%. Just check the calculation. 39,000 into 12.5% must give you 4,875. Okay. Less interest on loan. So you borrowed 15,000 rupees and the rate of interest is 10%. See, the rate of interest is 10%. So yes, you are getting 4,875 rupees of income in the new company, but at the same time, you have a risk to pay interest. So you paid interest and your net income after switching over to the unlevered firm is 3,375. Before switching over, what was your income? See, your investment was 24,000 rupees. And on investment of 24,000 rupees, you were earning 12.5%. That is 3,000 rupees. So I made additional profit. Fantastic. My additional investment is zero. My additional risk is zero. My additional return is 375. Now those are the characteristics of arbitrage. No additional investment, no additional risk, still additional return. If this is feasible, then definitely I will do arbitrage. If people start doing arbitrage, every rational person will try to sell shares in levered company and buy shares in unlevered company. So there will be a selling pressure on levered company and its price will start reducing. And there will be buying pressure on unlevered company and its price will start increasing. One price is reducing, other price is increasing, and eventually there will be a equilibrium and value of both the firms will become same, hence proved that irrespective of amount of borrowing, total wealth remains same. Now I'll tell you a fantastic shortcut to cross-check your answer, not to perform in exam, but just to cross-check the answer. See, you borrowed 15,000 rupees, right? And you invested this money in the shares of unlevered company. Now, your income from shares of unlevered company is 12.5%. And your cost of borrowing is 10%. So you borrowed 15,000 rupees at 10% and you invested 15,000 rupees at 12.5%. 2.5% additional return. So 15,000 multiplied by 2.5% will actually give you 375 rupees. That's the shortcut to cross check. Look, sir, if this is the case, why don't we borrow more? Why 15,000? You can borrow 20,000, 30,000, 40,000, or even more than that. Look, if you borrow more, your risk will increase. And with increased risk, if you are earning higher return, that is not something worthwhile. Okay? So that's the whole process of Modigliani and Miller approach. Now the last approach is actually traditional theory. Okay. Not getting any reactions from your side. Have you got it? Okay. See, NI approach is one extreme, which says that even if you increase the amount of debt slightly, you will see that the wealth is affected. WACC is affected. On the other hand, NOI approach is other extreme. You know what NI is saying? Even a slight change in capital structure will result in change in wealth. NOI approach is another extreme, which says that even if you change capital structure drastically, it's not going to affect your wealth at all. These are two extremes, East and West. I'll repeat what NI approach says. With more borrowing, your wealth will increase more. NOI says that whatever amount you borrow, wealth will remain same. NI says wealth is extremely sensitive to capital structure. NOI is saying wealth is totally insensitive to capital structure. Both are extremes, and in real life, both are, both doesn't hold good. Both are wrong. So there is a midway, which is called traditional approach. It says, there is an optimum level for doing anything in this world. Too less of the borrowing is not good, and too much of the borrowing is also not good. So what are the assumptions and conclusion of traditional approach? Look at this, the KD line from here to here. It says that with increase in debt, KD remains constant up to certain level. Thereafter, people see your company to be very risky and cost of debt increases. Same thing happens with KE also. Up to certain level of debt, KE remains constant, then it increases rapidly. So, if KD and KE both remains constant, with increase in debt, overall cost of capital reduces, keep on reducing. But when both cost of debt and cost of equity increases, then overall cost of capital also start to increase. So there is one point where overall cost of capital is at minimum level, and that level of debt is named as optimum debt. Moral of the story, NI says borrow as much as you can. NOI says doesn't matter. Traditional approach says borrow up to optimum level of your debt capacity. Lower debt means higher cost. Higher debt also means higher cost. So what type of question do they ask? They will give you 5-6 capital structures, and they'll ask you to calculate weighted average cost of capital for all capital structures and choose the capital structure where weighted average cost of capital is minimum. Okay. So that's it about the chapter capital structure theories. And now let's move to the next. That is working capital management. So give me 2 minutes and I'll open that file relevant. So here we go with the next topic, working capital management. Now somebody was asking, tell us about the important topics. Whole syllabus is important. Don't try to spot important topics. Just look at the past trend of 4-5 examination. I'm not saying that analyze the past 5 examination, try to guess the trend, and study only those chapters which were recently asked. No, I'm saying study everything properly because you want to learn it. And then if you want to strengthen some chapter more, then look at the past trend of the examination, recent 5 attempts. That will, you will yourself realize that what is more important topic. Okay. Working capital management. Now there are two types of working capital. One is the gross working capital, which is total of all current assets only. And other one is net working capital. That is current assets minus liabilities. You know, current liabilities may further be classified into two parts. One is operating current liability and the other one is financing current liability. Can you give example or can you define the two? What is operating current liability? And then what is financing current liability? No idea? Look, examples of operating current liabilities are creditors, outstanding outstanding expenses, etc. Yes, some people have answered it. And current liability simply means interest bearing current liability. That is, financing current liability means cash credit loan, cash credit limit, bank overdraft, book debts limit, commercial papers issued by a company, short-term deposits taken from public, short-term deposits taken from member, etc. These are interest-bearing current liabilities and named as financing current liabilities. In balance sheet, when I say current liability, I may include both operating and financing current liability as current liability. And hence in ratio analysis chapter also, when I say current liability, it includes both operating and financing current liability. But in working capital management chapter, when I say current liability, it means only operating current liability and not the financing current liabilities. Look, here it is written. It is current assets less operating current liabilities. Okay, in this chapter, we estimate working capital requirement for the coming year. What do we do in working capital management? We estimate, we forecast that what will be the amount of working capital required to run the business. So why do we forecast? You know, if we forecast and we know that next year's working capital requirement will be 20 crore rupees, while current year it is only 15 crore rupees. So I can make arrangement of remaining 5 crore rupees. I can go and talk to a bank, I can go and talk to financiers that next year I'll need 5 crore rupees more. Why do you forecast working capital in this chapter? so that you can make arrangement of money accordingly. It's similar to the concept, say there is a wedding in your family. Your elder brother is getting married, and you go to a catering service and you ask them, this is the menu. The next question they will ask you, how many guests will be there in the reception party? And you say, how can I tell you how many guests will be there in the reception party? You come at the reception and you see how many are coming. Make food accordingly. That's not going to work. You need to forecast. Yes, you need to forecast in advance how many people you expect at your wedding. Your means at the wedding reception at your family. And you need to give a number to the caterer so that he can make arrangement accordingly. You say 2,000 people will come and say he make arrangement accordingly. But you're quite a popular guy. You may be a political figure also. And 5,000 guests appeared. Now what will happen? Loss of goodwill. Beizzati ho jayegi. Because there will be shortage of food and your reputation will be at stake. The same thing happens in case of a company also. You make arrangement for 20 crore rupees of working capital. Actual requirement appears to be 50 crore rupees. You will be short of money. Your reputation will be lost in the market that you don't fulfill your commitment. And loss of reputation is like a heart attack. Your organization can immediately die due to crash of liquidity. On the other hand, if you say caterer 2,000 people will come and actually only 1,000 appear, but you have committed for 2,000, so you'll have to pay, pay for 2,000, and that's a loss of profit. It has gone unnecessarily expensive for you. Same thing true for working capital also. If you make arrangement of more money, but you don't use it, even if you don't use it, you need to pay interest for it. Guessing, estimating, forecasting a right amount of working capital is necessary. Some adjustment may be made at the last moment, but not a great adjustment can be done. There are two methods of estimating working capital. One is the operating cycle method, which gives you a tentative idea of working capital. Other one, there is no name of the other method. I have given it a name, working capital components method. What is operating cycle method? It says that the component of working capital work in a cycle. You start with cash, then you buy raw material, and your cash is stuck in the form of raw material. It's not like that you buy the raw material and you immediately consume it. You buy the raw material and keep it in godown. That is, you maintain the stock of raw material, because tomorrow, even if the supply of the raw material is cut, you can still continue to produce your goods. For the purpose of safety, you maintain stock of raw material. You take cash, you convert it into raw material, and your cash is stuck in the godown for say 2 months. Then when raw material is consumed, it becomes work in progress. Say for 15 days, now your cash is blocked in the form of WIP. When this raw material becomes WIP, it doesn't mean that the godown is empty now. New cash is converted into raw material. Then this WIP is converted into finished goods. Again, as soon as you produce finished goods, it is not sold. To keep inventory of finished goods, there are various reasons for doing that. So now your cash is stuck in finished goods, say for next 1.5 months. When WIP is converted into finished goods, the machines are not empty. A new raw material is inserted in machines and a new work in progress is there. When you sell goods, you don't get money directly. It becomes data. Say your money is again blocked for next 1 month, and then it becomes cash. And once it's become cash, you cannot withdraw it and take it to your home. It will again become raw material. This is called operating cycle. Now, the formula to calculate working capital under the operating cycle method is like this. So working capital is equal to cost of production divided by number of cycles. Suppose the annual cost of production is 12 lakh rupees. And suppose there are 4 cycles or say 3 cycles in a year. So tentative working capital requirement is 4 lakh rupees. You rotate cash 3 times in a year and your annual production is 12 lakh. So for each rotation, kind of 4 lakh production is there. One cycle, 4 lakh production, second cycle, 4 lakh production, third cycle, 4 lakh production. For 12 lakh rupees of production and for 3 cycles in a year, working capital blocked at any point in time throughout the year is 4 lakh rupees. But to use this formula, you need number of cycles. How do we calculate number of cycles? It is 360 divided by period of operating cycle. Or if it is in months, it can be 12 divided by period of operating cycle. So your one operating cycle is say 4 months. It takes 4 months to complete one cycle, say for example. So that's why in 1 year you will be able to complete 3 cycles. But now the question arises, how do I calculate period of operating cycle? How do I calculate period of operating cycle? So period of operating cycle is equal to raw material storage period plus WIP period plus finished goods storage period plus debtors collection period minus creditors payment period. You know, all these periods in real life, you don't calculate it. You decide it. You make a policy that I'll keep raw material for 3 months. I'll keep finished goods only for 1 month. But WIP, I have fully automatic machines. So my WIP is just for 3 days and so on. So all these periods you don't calculate, you decide it. It's a matter of policy making. But in an examination question, they may ask you to calculate it. So the raw material storage period is equal to average stock of raw material divided by raw material consumed multiplied by 360. Actually, the formula was this. I don't multiply it by 360, but yes, here I divide it by 360. Raw material consumed for the year divided by 360 will give you average daily consumption of raw material. So in the denominator, you have average daily consumption of material. And in the numerator, you have stock of raw material. So suppose you are holding 45,000 rupees stock of raw material. And suppose you consume 1,000 rupees of raw material per day. What does it mean? Even if you don't buy new raw material, your current stock is sufficient for next 45 days. And that is named as raw material storage period. Average raw material stock divided by raw material consumed multiplied by 360. Now the same logic will go for all other components. The work in progress period is equal to average WIP divided by cost of production multiplied by 360. Average WIP divided by cost of production multiplied by 360. In case of finished goods, it is average stock of finished goods. But in the denominator, you don't have a cost of production now, you put cost of goods sold. In case of daters, yes, average daters are there in numerator and you put credit sales in denominator. In case of creditors period, you put average creditors in numerator and credit purchase in denominator. So that is how you calculate each individual period. Now question arises, how do I calculate cost of production, cost of goods sold, etc.? So for that, you need to make a statement of cost. This looks like a cost sheet, but it is not exactly a cost sheet. So you start with raw material consumed. And how do you calculate raw material consumed? Can you type it in the chat window? I'm asking you a very simple question. How do you calculate raw material consumed? Yes, exactly. Opening stock of raw material plus purchase of raw material minus closing stock of raw material. Then you add direct wages and expenses, which is named as prime cost, but we are not concerned what is prime cost. Then you add factory overheads. Factory overhead includes factory related administrative overhead also. So that is kind of factory overhead. Then they name it as work cost, but I'm not again concerned with work cost. I add opening stock of work in progress and I deduct closing stock of work in progress. To arrive at the cost of production, you know, the name itself says it is the cost of finished goods which you have produced. This is your finished goods production. Then you add opening stock of finished goods. Then you deduct closing stock of finished goods to arrive at cost of goods sold. This is cost of goods produced. This is cost of goods which is sold. Then you add office related administrative expenses and then you add selling and distribution overhead to finally arrive at cost of sale, and then you add profit to arrive at the amount of sales. So try to recall that in the raw material storage period formula, denominator is raw material consumed. In WIP formula, the denominator is cost of production. In finished goods storage period formula, the denominator is cost of goods sold. In data's formula, the denominator is credit sales, not entire sales, only credit sales. In creditors period formula, the denominator is credit purchase. So keep this statement of cost in mind. This is helpful in this chapter. So now that's one method. Now steps for calculation. You make a cost sheet so that you know raw material consumed, cost of production, cost of goods sold and sales. Once you make the cost sheet, then you calculate raw material storage period, WIP period, finished goods storage period, data's collection period, creditors payment period. Once you calculate these 5 periods, then you can add the first 4 and deduct the 5th one to arrive at how much time will it take to complete one cycle, that is period of operating cycle. Once you know period of cycle, then you can calculate number of cycles. Once you know number of cycles, then you can calculate working capital. So the process, you know, I have given the answer in reverse manner, but the process starts from here and ends at point number 1. Okay, but you know, this method gives you just a ready and rough idea of your working capital. If you want to be more precise, if you want to be more accurate, then you need to use working capital components method. Working capital components method. This is a better method for estimation of working capital. In this method, separately. You know, this operating cycle method which we studied is kind of, reverse calculation. I told you, you don't calculate periods, you decide it. That for how many days I would like to keep raw material, finished daters, etc. You make a policy. I'll keep raw material equal to 1 month's consumption, 30 days consumption. And that's why in your godown, you have 30 days stock. It's not like that one day you visit the godown, oh my God, so much of the raw material is there. Let's count. Oh, this is sufficient for 1 month. It means I keep raw material for 1 month. No, no, no. Actually, you decide the policy. Accordingly, you have stock in the godown. So now this component method is working in the right direction. It says you have already decided the period, and so now we are going to calculate stock. So how do I calculate average stock of raw material? I need to estimate raw material consumed. How do I estimate raw material consumed? Simple. Number of units that will be consumed in a year multiplied by cost per unit. Then I divide it by 360. When yearly consumption is divided, why 360? That's the rounding off. In working capital management chapter, it is generally assumed that there are 30 days in a month and therefore there are 360 days in a year. So when you divide it by 360, you'll get raw material consumption per day. Now suppose you decided to keep 40 days stock. So raw material consumption per day multiplied by 40 days will give you the stock of raw material. Annual figure divided by 360 is per day figure. Per day figure multiplied by number of days for which you want to keep stock will give you the amount of raw material. Now exactly the same logic will go with all other things, with a little change. Just look at this cost sheet again. Factory overhead usually includes depreciation. Factory overhead usually includes the amount of depreciation, right? And finally, the amount of sales. So if it is included, depreciation is included here. Depreciation is part of cost of production. Depreciation is part of cost of goods sold. Depreciation is part of cost of sales, as well as depreciation is part of sales. So I can see two objectionable items over here. One is depreciation and other one is profit. Depreciation and profit. Profit is included in sales and depreciation is included in cost of production, cost of goods sold, cost of sales. Okay. But I would like to exclude these two items. You know why? I'll tell you a good reason. Say I am a trader. I don't manufacture. I buy and I sell. What do I trade? Anything. Say I trade this calculator. Okay. So I'm a trader. I buy this calculator for 100 rupees in the market. And then I sell it to the customers for 150 rupees. So one day you arrive at my shop and ask for a specific calculator. And suppose that calculator is not in stock. And I say, wait, I'll arrange it for you. I'll immediately go to supplier and take a calculator from him. Supplier will say, what about the money? I'll say, I'm coming in 2 minutes. I just thought I'll give it to you. You'll give me 150 rupees, 50 rupees. I'll keep it in my pocket and 100 rupees I'll pay to supplier. Full stop. So supplier asked me money and I said, wait 2 minutes, I'm coming back. Now I come to you and I give you calculator and I ask for money and you say, I'll give you after 2 months. You want a credit period of 2 months. You want a credit period of 2 months. So how do I handle it now? I will have to pay to my supplier immediately. But you will give me money after 2 months. So I'll have to borrow money. Yes, sell it to factor, borrow it from bank. How much money do I need to borrow? 100 rupees or 150 rupees? I'll go to a bank and I'll borrow money. But how much money do I need to borrow? 100 or 150? Come on, answer it. I bought a calculator for 100. I sold it to you for 150. I need to pay to supplier, but you are not giving me money now. You will give it after 2 months. Yes, exactly. I'll have to borrow just 100. I need not to borrow the amount of profit. It is as simple as that. I need not to borrow amount of profit. And that's why while calculating debtors, I'll not take credit sales. Let's assume entire sales is credit. I'll not take credit sales. I'll take cost of credit sales. So kind of I will exclude profit. Number one. Okay. I'll give you one more example. Say I'm a manufacturer of calculator now. So to manufacture this calculator, I need raw material of 40 rupees. Plus I need to give 20 rupees to labor, 40 rupees to labor, 40 rupees of raw material, 40 rupees of labor, and 20 rupees of depreciation on the machinery which is used. So my cost of production is 100 rupees. 40 rupees of the raw material I bought, I need to pay them. 40 rupees of the wages has been accrued, I need to pay that. 20 rupees of depreciation per unit has been charged. Total amount is 100 rupees. My profit margin is 50 rupees. I sell it to you for 150 rupees. You will pay me money for after 2 months. How much I need to borrow? 150, 100, 80 or 40? Exactly. I need to borrow 80. So I need not to arrange cash for depreciation element. So what I will do, Rather than taking overheads, I'll cut from here and I'll take only cash factory overheads. Therefore, this will become cash cost of production. This will be cash cost of goods sold. This will be cash cost of sales. And I won't include profit either. So this cost of credit sales will become cash cost of credit sales. Rather than cost, it is now cash cost. Cash cost means excluding depreciation. Credit sales means excluding cash sales. So the point to be noted is raw material formula will remain unaffected, but WIP formula, cost of production will be replaced by cash cost of production. Cost of goods sold is replaced by cash cost of goods sold. And instead of credit sales, now I'll take cash cost of credit sales. So see the formula. The WIP here in this formula is cash cost of production into WIP period upon 360. The finished goods formula is cash cost of goods sold divided by 360, that is per day cost, multiplied by number of days. Then for debtors calculation, I take cash cost of credit sales divided by 360 into debtors collection period. For creditors, it is credit purchase. So raw material is not affected because depreciation and profit were not part of raw material stock. And similarly, creditors are also not affected because again depreciation and profit were not part of credit purchase. Divide by 360 multiplied by the repayment period. Okay. And now you can calculate other figures also like outstanding wages, outstanding overhead. So you take the expenses for the whole year divided by 360 and multiplied by outstanding period. Instead of dividing by 360, you can divide by 12 if the period is given in months. If the period is given in weeks, then divide by 52 weeks. For weekly period, divide by 52. For monthly period, divide by 12. For period in days, divide by 360. Okay. So this point I have told you that why do you exclude depreciation and profit. Now let me tell you one interesting thing. You have excluded entire profit. Then what about the income tax and what about the dividend? Income tax is paid when you have profit. Dividend is paid when you have profit. So income tax is paid from the amount of profit. Dividend is also paid from the amount of profit. And we have ignored entire profit. And that is why if we are calculating working capital on cash cost basis, the perfect treatment is provision for tax should not be treated as a current liability and proposed dividend should also be ignored in current liability. Usually provision for tax and proposed dividend may be considered as current liability. But if you are calculating working capital on cash cost basis, then these two items should be ignored. Got it? Now, we have taken one inbuilt assumption. And that assumption is production is carried on evenly throughout the year. Production is carried on evenly, equally throughout the year. What does that mean? Production is carried on evenly throughout the year. It means that it's not like that in January, February, and March, 90% of the production is done. In rest of the year, only 10% of it happens. We assume that in each of the month, production is same. In fact, on each of the days, production is same. So when did we assume this? While you divided it by 360. If an annual figure is divided by 360, you are actually assuming that each day's production, each day's sales, each day's purchase is equal. It is by default an assumption in the formula. Okay, there is one more assumption which you need to take. If question is silent, we will assume that opening balance of all current assets and current liabilities are equal to their respective closing balances. If question is silent, assume that opening stock of raw material, if it was 10,000 rupees, then closing stock of raw material will also be 10,000 rupees, equal. WIP 5,000, closing WIP 5,000, equal. Unless otherwise stated, all closing balances are equal to their respective opening balances. Now what does that mean? So opening and closing balances of raw material are same. Does it mean that we have not consumed any raw material during the year? Opening stock was 10,000 and closing stock is also 10,000. So have we not consumed even a single unit? You have consumed it, but whatever you bought, you consumed. If opening and closing stock is equal, it means your consumption and purchase are also equal. If all opening closing balances are equal, in that case, if you're buying 1 lakh units during the year, it means you're also consuming 1 lakh units during the year. It means you're processing and finishing 1 lakh units during the year. It means you're selling 1 lakh units during the year. So what does it mean? Whether it is purchase or it is consumption or it is production or it is sale, it is same number of units. Now here comes a very complicated concept which is called calculation of WIP. Though we have seen a formula that WIP is cash cost of production into WIP period divided by 360, but this formula is rarely used. And rather than WIP is calculated using the concept of process costing. Have you ever studied process costing at any of your examination level? You have studied, that's great. In intermediate. Okay. All right. Look, probably if you can recall some of the concepts of process costing, this thing will become easy for you. For calculation of WIP means work which was started but which is not yet completed. So I don't directly calculate WIP. Rather than I calculate components of WIP. Now, what does that mean? So I try to estimate that how much amount of raw material has been used in WIP. Then I see that how much amount of wages has been incurred in WIP. Then I see that how much amount of overheads have been absorbed in WIP, like that. So that is, and then I make a sum total of raw material, wages and overhead to arrive at the amount of WIP. So how to do that exactly? First, we will try to calculate value of 1 unit of WIP. And then we will multiply it by a number of units which are in process. First, we will figure out what is the value of 1 unit of WIP, and then we will multiply it by number of units. Per unit cost into number of units. There are 3 inputs: raw material, wages and factory overhead. If any input, raw material or wages or factory overhead, is introduced at the beginning of the process, and usually it is raw material which is introduced at the beginning of the process. So raw material is introduced at the beginning of the process itself. At the beginning of the process, raw material is introduced, and then it keeps on moving and converted into finished goods. At any level, when I check raw material, initially if I introduce the full unit of raw material, full 100% unit of raw material, then at any level if I check it, it will be 100% complete as far as raw material is concerned. If initially it was 100%, then throughout the process it will remain 100%. So initially it was 100%. And at the end of the process also it was 100%. WIP is 100% complete with respect to raw material. Then opening plus closing divided by 2. So average completion stage of raw material in WIP will be 100%. WIP is 100% complete with respect to that input, say raw material. But if any input accrue evenly throughout the process, then WIP is on an average 50% complete with respect to that input. So initially wages incurred was 10%. Then at the next step of process, it became 20%, 30%, 40%, 50, 60, 70, 80, 90, 100. So in my factory, I will see various levels of WIP. WIP where 10% completion of wages happened, WIP with 20% wages completion level, WIP with 30, 40, 50, 60% wages completion level. Raw material is alike. Finished goods is, or raw material is all similar. Finished goods is all similar. But WIP, there are various stages. So some of the WIP, part of WIP is 10% complete with respect to wages. A part maybe 20, 30, 40% complete. So 0 to 100 on an average. If question says any input accrue evenly, if this accrue evenly phrase is there, if they say introduce at the beginning, it means it is 100% complete. If they say accrue evenly, it means that item is 50% complete in WIP. Okay, and then there may be a question can itself specify that what is the completion percent, what is the percentage completion of WIP. If the question itself says that it is 100% complete with respect to raw material, 60% with respect to wages, 40% with respect to overhead, then to calculate unit cost of WIP, use that 160, 40%, and then finally multiply it by number of units. Probably I'll give you one example for this. Allow me to create one example for this. Say annual production is 1,20,000 units. Okay. And WIP period is 1 month and unit cost sheet look like this. Raw material is rupees 100 per unit. Wages is say rupees 60 per unit. Factory overheads are say rupees 40 per unit. Cash factory overhead. So total cost is rupees 200. Okay. Annual production is 1,20,000 unit. WIP period is 1 month. Now, question says that raw material is introduced at the beginning of the process. Wages accrue evenly throughout the process, and factory overheads 40% at the beginning and remaining accrue evenly. Now this is quite complicated. Okay, this is the unit cost sheet, and I will now make a unit cost sheet for WIP. So rather I'll WIP in percentage terms, and then I'll take WIP in rupees terms. So see, raw material is introduced at the beginning of the process. So beginning 100, ending is always 100. 100 plus 100 divided by 2. Raw material is on an average 100% complete with respect to WIP is 100% complete with respect to raw material. So that is 100 rupees. Wages, it accrue evenly throughout the process. It means it starts from 0, but obviously it will end at 100%. So 0 plus 100 by 2, it is on an average 50% complete. Now that's 30 rupees. Now factory overheads. It starts at 40%. At the beginning itself, 40% overheads are accrued and remaining accrue evenly throughout the process. So 40 plus 100 divided by 2 is kind of 70%. So WIP is 70% complete with respect to factory overhead. So that's approximately 28 rupees. So WIP in total is going to be 158 rupees. This is per unit cost of WIP. Now, number of units in process. You know, 1,20,000 units per annum are there. And 1 month period is the process period. Divide by 12. Annual divided by 12 into period. So 10,000 units will be processed, will be in process. So WIP amount will be 150 rupees into 10,000 unit. That is rupees 15,80,000. Okay, there is a doubt. Can you repeat 28 how it came? Yes, it is 40 and it is 70% complete. So 40 into 70% gives you 28 rupees. This is how you actually calculate WIP. So this is one of the most complicated calculations in working capital management. How 70%? Okay. 70% is simple. You start with 40, you end at 100, and you divide it by 2. All calculations are made like this only. Everything ends at 100 because 100% completion means finished goods. Okay, now some special point which may be asked in a question. If a question is silent, then we will assume 360 days in a year and 30 days in a month. Yes, we already know that. If a question is silent, we assume 52 weeks in a year. But if question, specially mentions that 1 month is assumed to be equal to 4 weeks, if specially it is written, it means the intention of question maker is to assume 48 weeks in a year. So then divide by 48 rather than 52. If a question is silent and it simply says overheads, like rather than saying factory overheads, nothing else, then I will assume that it is factory overhead because I need a breakup. Factory overhead is something different. Administrative selling is different. Administrative and selling overhead are not part of cost of goods sold. They are added after the cost of goods sold. But if question is silent, I don't have a choice. I'll assume that it is the factory overhead. Now, one interesting point. Suppose once you calculate, raw material, WIP, finished goods, debtors, there are only 5 items, suppose in a question. Raw material, WIP, finished goods, debtors, and cash, full stop. And they want you to calculate total of current assets, that is gross working capital. Raw material, WIP, finished goods, and debtors you have calculated. But they, for the purpose of calculation of cash, they give you an information like this. If question says that cash is 5% of gross working capital. So cash is equal to gross working capital into 5%. But what is gross working capital? Just think about it. How do you solve it? Think about it. Look, that's simple. Because working capital is dependent on cash, and cash is 5% working capital. What is current assets are 95% of gross working capital. Remaining current assets are 95% of gross working capital. So you yes, it's good now. Give me 1 more minute, please. Oh, yes. I was saying, suppose packing material is also given. Then, packing material should not be included in the valuation of WIP. You know why? It should be included in valuation of finished goods, but it should not be included in valuation of WIP, because if the material is not yet fully processed, how can you pack it? So this is another special point which need to be considered. Now, the last thing that we would like to learn about this chapter is effect of double shift on working capital requirement. Look, if the demand for the product rises, in that case, if the demand for the product rises, in that case, I'll have to make more production. To make more production, either I can start a new factory or I can start one more shift in this factory. If I introduce one more shift in the factory, then what will be the effect? Now I am working 2 shifts, so my production is doubled, my sales is also doubled. Number of units I produce is doubled because now I am working in 2 shifts. And also sales is doubled. But the question arises, how will it affect the working capital? And the answer is, though the shift is doubled, though the number of units produced and sold are also doubled, but the amount of working capital is actually not doubled. The amount of working capital will increase, but it will be less than double. Why is it so? That amount of working capital will increase, but it will be less than double. Number one, the trade discount or bulk purchase of raw material. When I work in double shift, I will consume double raw material. When I consume double raw material, probably I'll become favorite of my suppliers and they will give me some discount, which is named as trade discount for bulk purchase of raw material. And that way, as far as units are concerned, raw material stock will be doubled. But the amount of raw material stock will not be doubled because now the raw material is cheaper. Higher wage rate for workers of second shift. Second shift is usually a night shift and people have the working hours which are not really very favorable. So if their working hours are unfavorable, they will ask for more wage rate. That will increase your cost to more than double. Then yes, you have rightly mentioned fixed cost. When I work double shift, still my fixed cost will remain same and therefore my per unit fixed cost will reduce. Because with same amount of total fixed cost, if my production is doubled, my per unit fixed cost will come down. It will become half. And that's why working capital increases, but it doesn't become exactly double. And then there is pipeline theory of working capital, which is used to calculate number of units which are in WIP. You know, say, see, this is a pipeline. This diagram is for a pipeline. If you, though I have tried to draw on it, I don't know whether it looks like a pipeline or not. But yes, it's a pipeline. And from here, the water enters, and from here, it exits. And the water holding capacity of the pipeline is 1000 liters. So earlier, municipal corporation was supplying water for 8 hours in a day. Earlier, the water supply was 8 hours in a day. And before the water could exit from the other end, 1000 liter of the water was blocked in between. Now, even if they start supplying 16 hours a day, even if the water supply rises to 16 hours in a day, it doesn't mean that now 2000 liters of water will be blocked in the pipeline. Still, the same 1000 liter of water will be blocked in the pipeline. This is called pipeline theory, and the same thing goes true for WIP also. You know why? How? Whatever work is left unfinished by the workers of first shift, that will be finished by the workers of second shift. So number of units which remain in process, raw material stock will be doubled as far as quantity is concerned. Finished goods quantity will be doubled, debtors quantity will be doubled, creditors quantity will be doubled. But WIP quantity will remain exactly the same due to pipeline theory of working capital. And all these things will actually cause the working capital to be less than double. So that's it for working capital management. And now we are heading for dividend policy decision. What is this dividend policy decision? A finance manager has to take three important decisions. One is investment decision. Where should I invest my money? One is financing decision. From where should I bring in the money? So I brought in the money from some sources of finance. I invested that money somewhere in a good business. Now I have started earning profit. So the third decision is, how much dividend should I distribute now? First question is, should I at all distribute dividend? If yes, then how much? That is dividend policy decision. Okay, now there is a demand. Please explain about factoring. Also, example for double shift of working capital because it is a little bit tough. Also, 110 net 30. Please explain this concept. Okay, factoring is a whole big chapter. We are short of time. We cannot do that. Example on double shift is also a very lengthy example. But 110 net 30, yes, that I can definitely explain. So under working capital management chapter, there is one thing which comes like this, 1/10 net 30. And what does it mean? Normal credit period is 30 days. But If customer makes payment in 10 days, then we will allow him a cash discount of 1%. So that is how you interpret this 1/10 net 30 thing. Okay. Example of factoring if time permits, definitely I'll try to take it. Chances are less, still I'll try. Okay. So I was telling you, data management. Look, I told you, if you wish, like 10:45 we will finish. It is 10:11. In next half an hour, I can speak out your whole syllabus, including derivatives, foreign exchange risk management, portfolio management, data management, cash management, factoring, dividend policy decision. Okay, small example of everything I can give, but then you won't be able to understand it. So, do you want me to skip dividend policy decision and talk about data management? I can do that. But let's stick to the agenda. So we are first going to discuss dividend policy, and then if time permits, if there is one more lecture, okay, for that you will have to talk to ICSI team. If there is one more lecture, if there are 5 more lectures, I'll cover everything. If there is one more lecture, I'll cover most of the things. Oh, that one more lecture is not mine, dear. That is some other faculty's lecture. You can request them. And yes, if there is one more lecture, I will do it. Don't worry. So, most important consideration while deciding dividend policy is to consider its effect on wealth. Consider its effect on wealth. What is the ultimate objective of financial management subject? Ultimate objective is wealth maximization. Wealth maximization. Oh, yes. Wealth means total market value. Total market value is market price per share multiplied by number of shares. So whatever financial decisions you are taking, keep in mind that while I take this decision, it should result in higher market price per share for my company. So should I give dividend or should I not? If I give dividend, how much dividend should I give? It should be based on the fact that whatever dividend policy I choose, it should result in higher market price. Okay. So let's see. Relevance of, there are various experts, and I can say there are 2 schools of thoughts. One school of thought says that dividend is relevant. If you change dividend, it will affect your wealth. The other school of thought is dividend is irrelevant. Whether you distribute it or you don't distribute it, whether you give lower amount of dividend or you give higher amount of dividend, it hardly matters. It is not going to affect your wealth. Wow, fantastic. If dividend is irrelevant, I can decide the amount of dividend by doing a so and give dividend like that. But if dividend is relevant, in that case, I need to be careful while designing the dividend policy. So, as I say, there are 2 schools of thoughts, relevance of dividend theories and irrelevance of dividend theories. As far as relevant of dividend theories are concerned, dividend capitalization approach is there. Walter's formula is there. Gordon's model is there. And Graham and Dodd model. Probably it's not part of your syllabus, but yes, it is an approach. When I talk about irrelevance of dividend theories, that dividend doesn't matter. In that case, earning capitalization approach is there, and the Modigliani and Miller approach is there. So before you study anything about any of the approaches, you need to know some basic formulas. Okay, somebody has posted one message. Archana Tomar is saying lecture is extended. Is it somebody from the ICSI side? Archana ji, are you from ICSI? Is it an official announcement lecture is extended? Okay. Up to 11. Okay, then just wait a minute. I'm not sure what exactly you're saying. Don't please confuse and waste the time. I got a phone call from ICSI side and it is up to 10:45 a.m. only. Please don't do it again. I need to close the chat box. Okay, so some of the basic formulas you need to know before you proceed. Dividend rate is equal to dividend per share divided by face value per share. But dividend yield is dividend per share divided by market price per share. Dividend payout ratio, it is dividend per share divided by earning per share. You know what is the difference between dividend rate and dividend yield? Dividend rate is dividend per share upon face value per share. And dividend yield is dividend per share divided by market price per share. Dividend payout ratio, how do I calculate it? It is dividend per share divided by earning per share. And retention ratio, it is 100 minus payout ratio. I hope you understand all these basic formulas. Book value per share is equal to equity shareholders fund divided by number of equity shares. And return on equity is equal to earning available to equity shareholders upon equity shareholders fund multiplied by 100. So return on equity formula can be like this also. You know, this return on equity formula is for total amount. Total earning available divided by total equity shareholders fund. Return on equity is earning per share divided by book value per share. Earning per share divided by book value per share. So actually what you did is you divided the numerator by number of shares and you also divided denominator by number of shares. So this is also the same, this formula for return on equity. Both formulas will give you same result. Price earning ratio. You know what is price earning ratio? It is market price per share divided by earning per share. And one of the formula for cost of equity is earning per share divided by market price per share. So this formula is 1 divided by K. Then CAPM equation, try to recall. So cost of equity is equal to RF plus RM minus RF into beta. Okay, so here we go with first relevance of dividend theories. And the first theory says that dividend capitalization approach. And dividend capitalization approach is P is equal to D divided by KE. Now, what is P? It is the current fair value is equal to D divided by KE. So D is the amount of dividend and KE means actually the cost of equity. Just a second, please. Okay. So here we go. Dividend capitalization approach says that P is equal to D divided by K. Look at this formula. The current fair value is dependent on two things. Value is equal to performance divided by expectation. Looking at this formula, what do you see? If I increase dividend, what will happen to the price? If I increase dividend, D, what will happen to the price P? Hey, I'm asking you a very simple question. You need to reply. Definitely. If dividend increases, price increases. If dividend reduces, price reduces. So this is how it is going to happen. It's very simple. So as per dividend capitalization approach, market price is dependent on dividend and therefore dividend is relevant. Higher the amount of dividend, higher the amount of market price. Look at this formula. If dividend is doubled, then market price is also doubled. If dividend is made half, then market price will also become half. Do you think that market price is actually that much dependent on dividend? Do you think that the market price is actually that much dependent on dividend? No, it's not actually. So we will not consider this to be a good approach. Yes, Graham and Dodd model, probably it's not part of your syllabus. I'm skipping it. But yes, Volta's formula. Now, this is a wonderful formula to interpret. Now, this formula says that P is equal to DPS plus R divided by K multiplied by EPS minus DPS whole divided by cost of equity. Look at this formula. Primarily, it looks like that DPS is there in the formula, dividend per share. So if I change dividend per share, it will affect market price share per share. If I increase DPS, market price per share will increase. If I reduce DPS, market price per share will reduce. But no, it's not the fact. Because there's a totally different interpretation of Volta's formula. in this formula, R means the rate of return earned by the company. R means the rate of return earned by the company. K means the cost of equity. So R is kind of return on equity. What is R? It is return on equity. Then what is KE? It is cost of equity. See, this will give you one very interesting interpretation. I'll take one example to explain it. Suppose my earning per share is 8 rupees and I decide to distribute dividend per share of just okay, and my return on equity, that is R, is 15%, and my cost of equity, that is K, is equal to 10%. Okay, now let's calculate what will be P in this situation, or better I will set up one table where I'll be putting two figures. If DPS is this, then how much is P? If I decide to give 2 rupees DPS, then what will be P? If I decide to give 6 rupees, then what will be P? Let's check. So here in this formula, I'll have to put DPS equal to 2 rupees plus R upon K. So R upon K is going to be 1.5. And 1.5 should be multiplied by EPS minus DPS. So EPS minus DPS will be 6 rupees. Divided by 10%, that is 0.10. So it is like this. 2 plus 9 divided by 0.10. So that's equal to 11 divided by 0.10. That's equal to 110. Okay, so if I decide to give 2 rupees of dividend, this will become 110 rupees. But if I decide to give 6 rupees of dividend, then this is 6 and this is 2. And that's why if I cut it short, this is going to be 90 rupees. Exactly. Perfectly fine. So what is moral of the story in this case? More the dividend I give, less the market price I command. You know what is the reason behind it? This R upon K. This whole formula is dependent on this single factor R upon K. So if the rate of return is more than cost of equity, this R upon K will be more than 1. Like this is 1.5. So whatever I put in the bracket, 6 rupees I am distributing and 2 rupees I am retaining. 2 rupees retaining, 6 rupees distributing. In total, 8 rupees is my EPS. If I distribute, it is outside the bracket. If I retain, it is inside the bracket. Whatever I put inside the bracket, it will become 1.5 times. And whatever I put outside the bracket, it will remain same. So 6 rupees remains 6 and 2 rupees becomes 1.5 times. Right? And that's why I would like to keep more and more amount inside the bracket because R is more than K. It means I would like to retain more and more amount and distribute less amount. Otherwise also it sounds logical. If investors are ready to give me money at 10% and I'm earning 15% in my business, there is no point in giving them dividend because if I give them dividend, they will invest that dividend money somewhere else at the rate of 10%. But if I retain that amount of dividend, I will reinvest that money in my business at the rate of 15% per annum. So I am making better utilization of money and that's why I should not give them dividend. So just a conclusion quick, if R is more than K, then you should not give dividend. Give least amount of dividend and the least is 0%. If R is less than K, you are not up to expectation of people, then don't give money. Give more and more dividend. in that case, the best policy will be 100% payout ratio. But if your rate of return is equal to cost of equity, then it hardly matters. Give any amount of dividend and it will not affect your price. So that's the conclusion. Now the next approach is the Gordon's model, which we have already studied under the cost of capital chapter, where it says that P0 is equal to D1 divided by K minus G. You know, if you analyze in depth, this Gordon's model formula will also give you the same kind of conclusion. If your R is more than KE, then you should give least dividend. If your R is less than KE, then you should give highest possible amount of dividend. Okay. So the two formulas are actually giving the same conclusion. Finally, so dividend capitalization approach says highest dividend is best. Walter and Gordon says if R is more than K, don't give dividend. But if R is less than K, give higher amount of dividend. All the three approaches together says dividend affect wealth. Now I am coming to the second school of thought, which says dividend is irrelevant. It does not affect your market price. So the first approach is earning capitalization approach. An earning capitalization approach says that P is equal to EPS divided by K. Look at this formula. There is no dividend in this formula. So even if I change the amount of dividend, it will not affect the current price. You know, in fact, this formula is logical also. I'll give you a logic and you will be convinced that yes, dividend is not important. Earning is more important. Say there are two companies, company A and company B. Company A has EPS of 10 rupees, while B has EPS of just 5 rupees. Company A decides to give dividend of 2 rupees and company B decides to give dividend of 4 rupees. So if you become member of company B, you will be getting 4 rupees. While if you become member of company A, you will be getting just a dividend of 2 rupees only. In which company you would like to invest money? Come on. A or B? Exactly. You know, the amount of 8 rupees which is not distributed is not a loss. It will remain with the company in the form of reserves and surplus. And it will increase book value per share of the company. And eventually it will increase market price per share of the company also. So if I decide to sell the share, I'll get appreciation in market price. You know, what is more important? You know, suppose you think like a kid, you're a school going kid, suppose, and think like a kid, what is more important to you? Your father should earn more or your father should give you more pocket money. God appears and says, if I increase your pocket money, your pocket money will be doubled and your father's annual income will become half. Will you say yes to it? No, not at all. Earning is important because the earning which is not distributed is accumulated. It's ultimately yours. Even if company doesn't distribute it, it belongs to you. So that's why earning capitalization approach is also right. The dividend should not affect the price and earning should actually affect the price. The simple thing, Modigliani and Miller has made it complicated. Yes, we do have Modigliani and Miller approach here also in dividend policy decision. It is there in capital structure theories and it is there under the dividend policy decision chapter also. And you know, what does it say? There are 3 steps for calculations under M&M. Under M&M, you have to make 3 steps of calculation. Step number 1 And you will repeat these three steps 2 times. Number one, you will do these steps with dividend. And number two, you will solve these steps without dividend, with dividend, without dividend. And when you observe that I'm doing with dividend, my wealth is 1 crore rupees. I'm doing without dividend, my wealth is still 1 crore rupees. And you will say, oh, it doesn't make any difference to my wealth. And that will be the conclusion that dividend doesn't affect wealth. How do you do it? First, you calculate P1, then you calculate delta N, and then you calculate current wealth. Let's quickly create one example. Say, number of shares in a company are 1 lakh. And the current price per share, that is P0, is equal to 100 rupees. And say cost of equity is equal to 10%. And let's say dividend per share, if it is given at all, will be 4 rupees per share. And suppose total earning for the next year is 10 lakh rupees. Okay, let's say 10 lakh. Wait a minute. And total investment. I'm trying to create a good example. I'm not sure whether it is going to be good or not. Okay, just give me a moment. Probably one ready-made example will be better, because if I experiment, example may not be good, and that will waste our time. Oh yes, we have one example. That's good. Oh yes, most of the part I was correct. 6 rupees is dividend, investment 20, net income 10. Good. Investment is 20 lakhs. Earning is 10 lakhs. And dividend will be 6 rupees per share if at all it is given. Okay, so let's solve it with dividend. If you decide to give dividend, sir, how come this steps? What is the derivation or logic behind it? No, that derivation or logic is too lengthy to pursue now. So let's just go through the steps. First, I'll try to calculate P0. And how do I calculate P0? P0 is already known and it is 100 rupees. And actually, I'm trying to calculate P1. So D1 will be 6 rupees. P1 is not known to us. 1 plus K is 1.10. When I solve it, P1 will be actually equal to 104. You can check it. P1 will be 104. Delta N, that is new number of shares to be issued. But sir, what is the philosophy behind it? See, Modigliani and Miller approach says that investment decision, financing decision, and dividend decision cannot be taken in isolation. You need to combine all these three decisions, then only you will be right. So that's why if you distribute more dividend, then how will you fund expansion of business? Then you will have to issue new shares. So how many new shares are to be issued? That is delta N. So investment I have to make is 20 lakh minus earning is 10 lakh plus dividend. N is 1 lakh share, D1 is 6. So 6 lakh rupees is dividend divided by P1 104. When I solve it in the numerator, it should be 10 lakhs, right? 20 minus 10 is 10, 10 plus 6 is 16. 16 lakh divided by 104. Is 15,385 shares. So I'll have to issue 15,385 shares. And now I calculate my current wealth. So how come this formula? We are not going to derive it, but yes, this is the formula. Time is the limitation. Otherwise, I can derive the formula for you also. N plus delta N, that will be 1,15,385. And now it should be multiplied by P1, which is 104, minus investment, which is 20 lakh, plus earning, which is 10 lakh, divided by 1.10. Some rounding error will be there. Otherwise, it is going to be 1 crore rupees. Exactly. Now I do the same calculation without dividend to check whether the value remains same or not. So now I'm doing without dividend. So when I do without dividend, I'll put dividend equal to 0. When I put it equal to 0, this will become 110. If I don't give dividend, my price will remain high. If I give dividend, my assets will reduce, my price will come down after 1 year, not today. And here also I will put 0. So 10 lakh divided by 104 is 9615. And here it will become 109615 into 110. Can you please help me to check these calculations? Oh, yes, it is 110. I'm sorry. So that's going to be 9091 now. Is it 9091? Okay, then 1,09,091 into 110 minus 20 lakhs. Now this will also give you the same figure, 1 crore rupees. So there are 3 steps. First is to calculate price at the end of first year. Then to calculate number of shares to be issued. If you give more dividend, then you will have to issue more shares at the end of first year. It will ultimately affect your financing decision. And then you calculate the current wealth using this formula, which is derived by Modigliani and Miller. And you see that the wealth is same under both options. And if the wealth is same under both options, in that case, I can conclude that wealth is not affected by dividend policy. Okay. So that's it for the day, because the session today is again scheduled up to 10:45. I know you have lots of expectation that I should cover more topics, but this is the time which has been allotted. So I can say now you goodbye and wish you all the best for your examination. If you want to learn more, search me on YouTube. I'm there. Search me at my website. I'm there. My contact details are there. You can get in touch with me even after this session. Okay? All right then. Thank you. Bye-bye.